Bloomberg Audio Studios.
Podcasts, radio, news.
Brian Moynihan, who's the chairman and CEO, of course, of Bank of America. Brian, really great to have you with us, and we appreciate you joining us. You're here to celebrate a significant milestone. What's the mood music been like?
Well, it's been a great time to be here. Our team is celebrating 60 years in this country, and they're all excited about it. We have a great business here, and Joe and the team do a great job. And yeah, the mood's pretty strong. I mean, everybody's worried about geopolitics and all that stuff, but the day-to-day business activity, the people seem confident. Our team's having a good year in the markets business and the corporate banking, investment banking business. We wish IPOs are going faster around the world, but overall it's pretty good.
In terms of how you characterize the Australian market, how do you see it? Is it a growth market for the business?
It is. We basically, if you think about the last decade or so, we tripled the size of our exposures here. Following our clients. We do corporate investment banking for large companies, treasury services to move money around the world for those companies, and then we do markets for equity investors and fixed income investors from around the world, and Australian investors investing around the world. And so those businesses are strong, growth businesses in our company and growing here. And a simple way to think about it is we tripled the size of the risk we're taking in the last 10 years.
It's a fascinating time for markets at the moment, as it has been over the past few years. But I think the last time we saw Treasury sell off to this extent, Alan Greenspan was in the middle of orchestrating a soft landing. You guys are in the no landing camp. Do you think what's going on with bond markets, a recent, relentlessly resilient string of data, does that just bolster that view for you?
Yeah, and I think we not only have all the general economic work, we have the top research team in the business. They do a great job, Candace Browning-Platt leading them, and all the colleagues around the world. But we also have 60 million American consumers. And so when you think about the U.S. economy, we have great insight into what's going on. If you look at that consumer spending this year, the month of October so far versus last year, or third quarter versus last year's third quarter, it's up in the 4 to 5% range, which is consistent with a low inflation, low growth economy. That's across about $1.25 trillion to $1.5 trillion spent in a quarter. So it's a big sample, and the people moving around, they spend it each quarter on all different things, but it's generally growing consistent where we were pre-pandemic when you had Fed funds rate at the 2% level, 2.5% level. You had inflation in control, and you had growth in the 2% level. So that gives us confidence that our experts that do all analysis are backed up by the data we see in our clients, and that's what we see. For
the consumer, is there a degree of bifurcation there demographically?
It's less about bifurcation, because I'd assume that there's sort of two. Look, inflation hits people in the lower income brackets more than it does others, but the good news is gas prices have come down, food prices have tipped over, inflation's in control, it's down in the 3% range as opposed to it was running pretty hot, and so that helps. But if you have auto debt, that debt, and you want to get a new car, that debt is higher. If you have mortgage debt and you already had a mortgage loan, it's very low. And so it really depends on the consumer and really where they are. But the average American consumer has more money than they did before the pandemic, is in better credit quality before the pandemic, still has the money in accounts from some of this stimulus in the pandemic, and is spending money. And that's all good stuff for the U.S. economy, because we're such a that's the unique thing about it. It's a consumer-driven economy. It's a consumer-led economy.
Are you thinking about making allocations or allowances for stress at this point?
We always do that. So every quarter we run stress tests, thousands of them. Every day we run them in the markets business stuff. We always look at it. And so what's the case if it turns out the wrong way? So even how we set our reserves, we have a modeled series of cases we put in. So it's not all base case. Base case is about half, and the rest are stress cases, and you add them all together. We're actually set our reserves as if unemployment was going to be at 5% at the end of next year, not what the market predicts at 4.3. So there's a conservatism built into that, and then we look beyond that.
There's also some potential complications for the Fed depending on what happens in just under 2 weeks' time, right? Does the fiscal scenario, particularly under another Trump administration, but also certainly there are risks when it comes to the Harris camp as well. Is that something that you're thinking about? So
I would separate a very near-term question of the Fed getting the trajectory. Our experts have them cutting again a couple more times this year, so 100 basis points this year and another 100 basis points more evenly spread each quarter next year, and gets to 3 to 3.25 as a terminal rate. And then inflation comes down to the 2.3% as we move into 25 and 26. And so that is a well-engineered Fed change. And so the danger is that data, or they go too fast or too slow, and that risk is higher now than it was 6 months ago. And so as they move, everybody's going to watch them, and you see the sell-off in treasuries one day and you see the rally the other day. Everybody's going to watch all that. That is completely different from, and I don't think that'll be impacted by the elections at all. The fiscal problem in the United States, and to give you the soundbite, The U.S. just finished a fiscal year. The budget deficit for that year was equal to the entire economy of the country of Australia, $1.8 trillion. So think about the size of that, and we've got to get it back in line. These are good times, and we should be managing it more carefully. And frankly, we need to have the politicians who set those budgets, fund those budgets, and run tax policy against those budgets to figure out how to make this work. It's probably going to be raising revenue and cutting expense or some combination. It's not a new problem, but it's one we got to start to wrestle with. Not that it's critical tomorrow morning, but it'll be critical over the next few years.
But given that risk, do you think the Fed went too big too soon?
No, they were late to the game, and they admit that, so it's nothing that we're saying. It's they were late, and they had to move fast because inflation got ahead of them, and they've done a good job of bringing it back down from probably a double-digit rate down to about 3% last quarter, 3.25%. So they're getting close to it, and it's never. The inflation average from one of my teammates told me from 1990 to 2024 was 2.5%. The inflation average from 2000 to 2020 was 2.5%. It's 4.5% just in the last 2020 to 24, and so we've got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now, and that's what they are all trying to figure out watching the data. But whether it's a terminal rate that's the key, and that we think is around 3%. That's a whole different interest rate environment in the U.S. and other markets than it's been in the last 15 years or so. We haven't come close to that level of front end rate in a long time, and if that's what is done, that's a better place for the U.S. to be, frankly.
During the most recent earnings, you said you'd provide guidance when it comes to net interest income for 2025 next quarter.
Yeah.
What data points are you waiting on at this point?
The difference of a Fed cut or not can mean $300 or $400 million a quarter for us and stuff. So when they come, how fast they come, and all that stuff, and then also just getting closer to the near term. We try to stay with what's really relevant to investors, which is the near term path. The long term path, we have about a 2.00%, 1.93% net interest margin. That's a percentage spread. That should move back to 2.2, 2.3. That'll happen over time. The path of that will be determined by all the different things going on in the environment around us. But we are growing our NI. Not very many people are. So we grew from the second quarter to the third quarter and told people to grow from the third quarter to the fourth quarter. That's unusual. Most people are flat to down, and we're starting to grow.
We saw some really strong numbers, both on income and on margin. Is that sustainable?
Yes, in that we're actually running up margins that are actually underneath our typical margins, largely because the net interest income has to spread back out. And so as that moves up, we can get back to operating leverage. For 5 years in a row, we had operating leverage before the pandemic, and then a couple years in the pandemic, then we picked it up for about 6 or 7 quarters. We got to get back in operating leverage, i.e. growing your revenue a little bit faster than your expenses. Not a lot faster, just a little bit faster. And as NII kicks in, and the loan deposits kick in, and the $3.3 trillion balance sheet, that's what drives it. So we earned about $6.9 billion after tax. We're one of the few companies that's earned that much money many years in a row. This is our 10th year of earning more than $15 billion after tax. All good stuff. But the reality is we still have a lot more earnings growth ahead of us. What
are you seeing when it comes to deals, confidence, broader capital market activity at the moment? Do you feel like it's going to be an acceleration into the end of the year, or maybe a slowdown?
The debt capital markets are aggressive, strong, and there's a lot of issuance going on. We just issued today, and that's going on. The equity capital markets, some good views of what some IPOs are getting done. You're starting to see that set up. It appears the IPO calendar will be strong for profit-making companies going public because the investors are sitting on a lot of cash, and the IPOs over the last 6-12 months have worked. In other words, they've come out to the market and gone in the right direction. Therefore, investors are gaining confidence at the quality of the companies and what they see. We think there's a pretty good prospect for that on a go-forward basis. On M&A, it's solid, but with the uncertainty around the world on regulatory policy, getting deals done, the pace at which you can get deals done, and whether it's in Europe or the U.S. or other places, all this has slowed the activity down. But our clients are sort of chomping at the bit. They see opportunity. They see opportunity to buy companies and increase the quality of their platform. And so there's a good pipeline. It's just that we got to make sure that it gets done.
And the central bank cycle certainly helps in restoring some of that confidence, right? What about politics, though? Do you get a sense that maybe people are staying by the sidelines now until the outcome post-November is better known?
I think if you think about what's really affecting the small, medium-sized business in the United States and other countries, as you had this rapid increase in rates, because the U.S. has a fixed mortgage market, it really doesn't affect landowners that quickly. It takes time to get through that. Auto loans go up. Credit cards go up, but they're already pretty healthy rates. So it does affect consumers on the rate structure when it goes up. Confidence-wise, opportunity-wise, it really affects small, medium-sized businesses. If your base rate, with SOFR was 50 basis points and now it's 5.5, that difference is all cost of funds for them to borrow. So that's had more of a damper on their activity than anything else. Are they waiting for the election to get done so they can figure out what the policies are going to be under whatever it's going to be a new administration, frankly, on both sides, right? Because even though Vice President Harris was a vice president, now she'll be president, or Donald Trump has been out of office for 4 years, he'll be back being president. So both those policy platforms are not well understood by businesses. But the big driver of their reluctance has been waiting to make sure final demand stayed in, waiting to make sure the rate structure came down for their activity. So they're not using their lines as aggressively as they were in normal times, and that's part because the cost of them is higher, so you're going to be more assured of the outcome. Are they investing capital? Yes, but not as strong as they will as the rate structure comes down.
Does recession risk still sort of play, or is that in the background now? Do you think if the labour market holds up, it's going to be okay?
Yeah, with an unemployment rate of 4% plus, 4.1, with a wage growth rate of 3%, and with inflation down around 3%, it is really hard to have an economist convince the world that there's going to be a recession. Now, none of that takes into account all the parade of horribles that could go on a given day. The escalation of physical wars, trade wars, bad policy, the fiscal situation in countries percolating more. Those are all things that could happen. But if you look at it from the standpoint of the United States, people are working, they're getting paid, and they're spending money, and that's a virtuous circle, because when they spend money, that means people are working. And so that's pretty good. And we've absorbed a lot of workers over the last few years and put them to work. So it is hard to predict a recession with this low unemployment and this much wage growth. That doesn't mean it can't happen fast if people lose confidence, business lose confidence. So what you should be watching is consumer confidence, small business confidence, and they're solid, although they came down a little bit. And then when they cut rates, the consumer went up a little bit. The small business is still hanging in there. So let's watch that play out over the next few months. If they get confidence that the cost of capital for them from a debt side is coming down, they'll move faster.
We talked a little bit around politics and the election. Have you spoken at length with either candidate?
We give our advice to everybody. So, I think people always ask me, what about this? Or you have a desk drawer for candidate A or a desk drawer for candidate A. We can't do that. Our company's been around since the 1780s. So, as I say, there's been a lot of tough elections in the United States since then, including that one in 1800, which they made a great play about called Hamilton. I mean, this is the United States goes through this every 4 years, as your country goes through every 3 years. It's just part of what we do. Is this one different? Everyone's different. And our job is to advise the candidates before and after as to what the best policies are for the good of the American economy and the good of America's role in the world. And we'll do that. We've been doing that for years. As CEO, I've worked with, even before I was CEO, I've worked with presidents on task over the course of time. We'll continue to do it.
A lot of your peers have endorsed a candidate. Do you have a view whose policies might be better for the economy?
We'd have a view of that, but it has nothing to do with endorsing a candidate. We at the United States have to focus on the debt situation we talked about. We have to create the conditions of growth in the core industries we have. And that's not only good for the United States, it's good for the world. If the United States is in solid conditions, the rest of the world can adapt to that. And because the size of our consumer economy helps the rest of the world, the size of our business economy helps the rest of the world. And we're codependent on them. They help us, we help them. So I think I wouldn't get into that. It's always a problem that if we say someone's good and someone's bad, somebody overreads what it is. So our job is to stay out, let the American people decide, and then we'll go work to make what's best for America and the world, honestly.
And what's best for America, is that you working within an administration? I know you get asked this all the time, but is that something that is still an open door at some point?
Our job is to get the private sector and to keep driving. What we're working here in Australia with the Sustainable Markets Initiative that I work on the auspices of King Charles, and we worked with him with a bunch of private sector CEOs to help move the transition faster on a cooperative coalition on a willing basis. Our job is to work with others in other types of settings to do that. So I do love what I do, and I'll keep doing it as long as they'll have me.
It's a big week for Australia. We've got both the Royals and Brian, you in town as well. But I'm glad you talked about the sustainability initiative, because this has felt like a year that's been quite depressing when it comes to that energy transition. What do you, from where you sit, where do you view the impetus here?
Yeah. I would not argue with you that, because that's what you read and feel. But the reality is the work that's going on because of the commitments companies have made and them living up and driving those commitments. So people sort of divorce what you're seeing as the AI revolution hits. all these initiatives to use clean energy or even clean nuclear energy and restarting nuclear plants or small modular nuclear or solar or wind, all these activities are going on strong. And so while people are debating about this in more the public domain, meanwhile, you've gone from literally 3 or 4 offshore windmills operating in the United States to about 15 or 20 now, and a bunch of them approved, and they're going in the ground. We do several $billion of tax credit deals in the United States. So the investment rate today, the financing rate, we committed to $1.5 trillion to fund around $1 trillion to fund around the environmental change. We're about $400 billion. Our clients are demanding it. That activity is going on, and they're all working 1,000 different ways on driving it. And so I think despite the debate about the public setting and stuff, we believe that oil and gas and things like that are critical, and we believe that green energy is critical, and we got to make it all work together. And a country like Australia has that. You're seeing it play out in front of the page of the papers with the energy summit going on. It's that classic dialogue. We got to keep good energy, we got to keep good power, we got to keep the economies going. At the same time, we got to make a transition, and the private sector is driving that. So I don't get depressed at all. The amount of activity I see is unbelievable.
I want to know how much you can sustain that energy for, in terms of being, of course, already one of the longest held roles on Wall Street, and you've been around for a long time. And also, happy birthday. I know that you turned 65 this month. How long do you plan on sticking around for CEO?
Well, I said until the board. I serve at the day, on a day-to-day basis for the board, and my plan is to continue working for a substantial period of time here to help the team along. But the real job I have is to continue to build a team that will succeed me, because this company is
Talk to me about succession. Can you give us any names?
No, we wouldn't do that. That's not for public consumption. But we have a plan, and we work on it all the time, and it ebbs and flows, and people come in and out. But the idea is, it's not just the CEO; it's the whole management team, and who will be there for that CEO to rely on to and drive the company forward. And so we're here for a moment in time. Our company's been here for 240 years almost. And so it'll go on for another several hundreds and hundreds of years. And so the idea is we move the wood pile, and hopefully left a little bigger, and we got to leave one of the pieces that's got to be bigger is another management capability across not only the CEO but the rest of the team.
One last question. Speaking of Stroud-Watts, Warren Buffett continues to reduce his stake in Bank of America. Have you spoken to him?
No, because it wouldn't be right to speak to him about his share ownership when he owns that much of the company. But he's been a great investor. He invested $700 million or 700 million shares in 2011 and bought another 300 million. And I think he isn't talking about it. We wouldn't talk about it. But he's been a great supporter of our company, and we benefit by that support.
Brian, so great to have you with us, and thank you so much for joining us here in Sydney. Brian Moynihan, who's the Chairman and CEO at Bank of America.